Today, we have the pleasure of speaking to Sam Burns, founder of Mill Street Research. Sam, welcome to Forward Guidance.
Hey, thanks, Jack. Appreciate you having me on.
We're glad you're here, Sam, because you not only analyze the macro, you analyze earnings, and specifically what analysts are tracking for earnings. 2020 and to some degree 2021 was a year when it was a lot about narratives. It was fueled by narratives and liquidity. But right now we're sort of in the show me phase in terms of assets. It's like you make money, we'll continue to buy your stock. But if you don't, as we see today on the 6th of January, profitless tech companies, richly valued companies that don't make profit, if at all, any revenue, are being punished quite severely. So I'm really glad to have you here. But your earnings forecast model, it's pretty complicated. So before we get into that, let's just zoom out and talk about the macro. How are you weighing the risks and reward in this market? I know you look at things like momentum, credit risk, real yields, metal prices, Fed expectations. How are you sort of weighing all of that in terms of evaluating the opportunities and risks that lie in stocks?
Yeah, that's right. Yeah, we often start with a top-down view before we go trying to dig into individual industries and stocks, and particularly nowadays that's very important. The primary sort of timing tool I use for kind of a 3 to 6 month view on equities and really risk assets in general, kind of the risk on, risk off trade, has been what I call a global equity risk model. And it's got 8 indicators like the ones you described that are based on equity returns, various forms, volatility, price momentum, things like that, and also cross asset things like credit spreads, metals prices, Fed expectations, the Treasury market. All those things kind of go into it to describe both the backdrop and the actual market behavior that we're seeing. And those indicators I found have a good track record for helping gauge risk and reward over the next few months. And right now they've kind of been backing off from having been very, very bullish from kind of probably August, September of 2020 all the way through just recently. They were in the maximum bullish reading. They've now kind of pulled back to sort of a moderately bullish reading on that overall kind of composite model that I use. And that's really consistent with the fact that we're now getting close to the point where the Fed is going to be probably raising rates this year. So it's now come to that point where a lot of the monetary stimulus is starting to kind of stop being provided, maybe starting to taken away a little bit. And the price momentum and the kind of the speculative enthusiasm that was so prominent in late 2020 and much of 2021 is also fading, partly because the liquidity is being withdrawn and partly because those things just only go on for so long. So those kind of things are kind of early signs that we're moving kind of early stage to sort of mid stage in the market cycle, and that's also true of the economic cycle. I think the backdrop is still favorable. Bonds and real interest rates are still very low. They don't offer a lot of competition for equities and risk assets. The economy is still growing in the U.S. and globally. Earnings are still growing. So all that kind of fundamental backdrop is still fairly good, but the real strong tailwinds we've had are starting to kind of moderate and are now more balanced between kind of headwinds and tailwinds, I would say.
And when we see this model, such as Fed expectations is at 6%, what does that mean?
So that basically means that relative to the last few years, if you look at kind of what market expectations for Fed policy are, and so here we're just looking at the comparison between what the 2-year Treasury yield is yielding versus what Fed funds are, or kind of the short-term 3-month yield. That gives you a feel for where the market expects the Fed to be in a year or two. And that's moved. The 2-year yields have moved up a lot. They're up around 70 some odd basis points now, and that tells you that there's multiple rate hikes that are being priced in now that were not the case, a few months ago or a year ago. And so that's telling you that having been for several years having the Fed, looking at either lowering rates or keeping them at zero, we're now to the phase where they're starting to raise rates. And historically, that's been something of a headwind for equities and risk assets in general. It's not necessarily causing a bear market by itself, but it tells you that you've lost some of that. So basically, that 6% just means that we're at the 6th percentile of the historical range for that indicator. So all these indicators that I look at are kind of percentile scored, so that 0 is worst and 100 is best. And so having been at very high readings for a long time, a lot of Fed support, we're now kind of moved to the other side, saying the Fed is withdrawing support, and that's a net negative for equities.
How hot do you think the economy will be in 2022? Do you think we'll see a continued boom in demand for durable goods alongside a renewed vigor in services spending, or do the bears have a point that the bloom is sort of off the rose for 2022?
I think that the overall economic growth for 2022 will generally be pretty good. I think the forecasts now are for 3.5 to 4% real growth, and then 3 to 4% inflation gets you to some sort of 7 to 8% nominal GDP growth. I think that could happen, and that would be in line with actually current bottom-up analyst forecasts for revenues and for earnings for the S&P 500. The kind of 7% revenue growth and 8 or 9% earnings growth is kind of what the current forecasts are. So analysts are not expecting profit margins for corporate America to expand dramatically further from where they already are. They're already quite high. So in terms of top line kind of GDP and revenue growth, I think it'll be pretty good. Some of that will be inflation, prices going up, and some of it will be real growth. I think the real growth will be relatively solid for those reasons that I mentioned. I think that the risks are either Fed over tightening or fiscal policy retrenchment, some kind of limitation on fiscal activity, or obviously if there's another COVID wave that really retrenches things again. Certainly we all hope that doesn't happen. But the fact that it looks like the Omicron wave may kind of move along by at least March maybe. By the end of the first quarter, and that if things do improve the rest of the year, then those sort of forecasts for economic activity, could hold up or even improve a bit. So I think the economy and earnings will do fairly well. I think there is some upside if the supply chain and kind of inflationary pressures get worked out a bit, and there's no big new COVID wave, and policy is reasonable, supportive. Even with a couple of 3 rate hikes, I think you could get a decent economy. And therefore, there's no reason to be heavily bearish. Valuations are kind of high for equities on a historical basis, but not relative to bonds, certainly, and not on a current year earnings basis. So I think there's not much alternative to equities still. So I don't know if you sold all your stocks, what would you do with it? It's still an open question.
Buy Bitcoin. Come on. I'm just kidding.
Yeah, whole other risk category there.
Yeah. Sam, what so that bullish view, relatively bullish, moderately bullish view you just laid out, you expect robust economic growth. What would it take, Sam? What would you have to see, whether in earnings revisions or in the macro, in the data, in the stock, in the price action, for you to change your mind?
So I think the downside would be if kind of input costs and wage costs, things like that, go up enough to really dent profit margins. That if companies can't raise their selling prices fast enough to compensate for wage and input cost growth, then that could be the thing that hurts margins and therefore earnings, because margins are quite high. Now a lot of that is concentrated in the tech sector, but a lot of other sectors still have relatively high profit margins compared to history. That's certainly a risk. China, is certainly a risk. It's been kind of weak, but if it really started to see a big downdraft, either because of property speculation or tightening of economic policy or whatever, that something got weaker than expected there, that could be a drag on overall economic growth, and certainly supply chain issues, things like that could emanate from China. And then again, policy risk, if it looks like that fiscal policy will suddenly become much more restrictive and contractionary, if the Fed decides to respond to inflation much more aggressively and tightens too much, that would be a downside risk as well. And those are things that have happened in past cycles for sure. In terms of market sentiment, people are pretty optimistic and bullish here. I think there is some risk that people get more cautious, but that would need a catalyst, I think. I think there would be something that would have to change in the macro standpoint to make that happen. I don't think it would just going to happen all by itself necessarily. I wouldn't recommend going back into the really volatile small cap, profitless growth companies. I don't think they're going to suddenly have a big resurgence, but I think overall equities can can hold up. I think earnings will do relatively well. And so as long as there's that kind of underlying fundamental support and there's not a great alternative from fixed income or other assets, then I think that equities and risk assets will do okay. But those are the downside risks, because it's a policy mistake, China or profit margin squeeze.
But by the way, those profitless small cap growth names, they're not, almost by definition, not a huge part of the S&P 500. So I could see those stocks doing very poorly on an S&P 500 holding up. Sam, you mentioned the Federal Reserve raising rates. What type of stocks is the Fed hiking rates a greater threat to? Cyclical small cap value companies or cyclical or speculative small cap growth companies?
Yeah, I would say that a lot of the sort of cyclical companies, industrials, consumer, materials, commodities type stocks, most of those can withstand rate hikes by the Fed, at least up to a point. Going from 0 to 75 or 100 basis points generally won't hurt those kind of stocks if the economy isn't. I mean, if the reason the Fed is raising rates is that the economy is strong. If there's strong economic growth, then small moves in short-term rates won't hurt those kind of cyclical names much. What we've seen recently is people responding to the sort of long duration stocks, those stocks where their earnings are far in the future, they don't have current earnings or very little current earnings, and therefore the kind of the trend in long-term interest rates is going to be a concern in terms of the kind of discounted cash flow type analysis that people do, where a movement in the long-term interest rate affects how you value stocks where the earnings are in the distant future. I think that effect in reality is probably overrated. If the 10-year Treasury yields 2% instead of 1.5%, a stock that's growing at 20% isn't going to matter much. It's the change in the expected growth rate that matters. So if you thought a stock was going to grow at 20% and now it's going to grow at 15 or 10, the stock's going to go down, whether interest rates move 50 basis points or not. And I think that's the question: is as we get to the point where people are going to be a little more demanding about whether the companies can actually make their forecasts, or kind of grow into their valuations. The ones that can't are the ones that are now and maybe in the future are going to be the weakest areas. And so I think that's the real risk, is that those stocks that have really high expectations built into them, have to come back to earth. The traditional cyclical names that have low PEs and don't have really elevated expectations, they can withstand higher rates. They aren't dependent on that. They're more dependent on the economy. The other ones are more dependent on kind of their own secular growth story, and they can't all win, kind of thing. And so I think there it's more just a question of the growth expectations and how they change.
I just a point on the discount rate and long duration stocks. I think it can be confusing because on days where long-term bonds sell off hard and yields spike, those tend to be days on which the NASDAQ 100 sells off hard as well. So I think on an intraday basis or a one-day return basis, they're very correlated. But you're saying that on a longer term basis, the fact that the yield is at 2% versus 1.5% doesn't affect the long-term return potential, but 1.5% going to 1.6% in one day, that affects QQQ in one day, but whether it's at 1.5 or 2 in terms of absolute level, not that big of a deal.
Exactly, and definitely true that on a day-to-day basis, the large cap, the long-term, the growth stocks do very much respond to movements in interest rates. If there's a big move in bond yields, then the long duration stocks tend to lag, and it's almost a mechanical thing that traders do in the short run. Yeah, so I'm very much talking about kind of the longer term, prospects for those companies and their valuations is probably less tied to the level of interest rates when rates are generally very low than people kind of then you would assume if you just extrapolate from those day-to-day moves. So I think if you're holding for 6 months or a year, it doesn't matter as much, or certainly for 5 years. But day to day, on a tactical basis, rate movements and those kind of rotations between growth and cyclical value are very much a real thing.
And Sam, what are you seeing when you look at what's doing well in the equity markets with regards to style and factors? If you look back over the past 2 years, you can put a particular periods of time in distinct chapters. From March 2020 to, let's say, August, mega cap growth was doing really well. High beta cyclicals were not doing well at all. That reversed in November, going through March, when risky cyclical stocks rallied alongside speculative growth names. And that's sort of reversed again, going from March to December. Now it seems like we could be at the precipice of a new market regime where those speculative growth names are really taking it on the chin. You look at a poster child for those very disruptive growth companies in the ETF ARKK, and you're seeing some pretty momentous losses. What are you seeing? What does the dispersion of the factors in the equity market tell you about where we are in the regime, and what's coming down the pipe?
Yeah, that's right. I think we followed in some ways a typical market cycle, but compressed in a lot of ways, or the amplitude has been dialed up by the fact that the COVID itself and then the policy response to it were so historically extreme. The Fed tends to cut, when things get weak in the economy, but it was much more aggressive with its bond buying and even expanded its powers, as you remember in 2020, to be able to not only buy treasuries and mortgage bonds, but to buy corporate bonds and junk bonds even, which it never had before. And that, I think, kind of changed the landscape and produced a lot of that willingness to buy speculative assets, even in conditions that were very uncertain at the time. And then you had the massive fiscal stimulus, which was much bigger than anything we'd seen, at least since World War II, really. All of that combined, produced this extraordinary move in both the economy and in markets. Now those have been sort of pulled back some naturally. You can't keep that up forever. And now we're following kind of the same cycle where the really speculative most volatile stocks do well early on, and they did. They've peaked and have now fallen back. And so it's some more of the kind of stable growth and some of the cyclical companies that benefit from a strong economy, but can also withstand somewhat higher rates and don't depend on that kind of aggressive liquidity provision, are the ones that are now kind of taking over the leadership. So I think the key is that the economy and the earnings are still there. They're still growing, just not at such an extraordinary pace. And investors are still wanting to own equities in general. They're not pulling out of stocks. They're just rotating from the riskiest stocks to kind of more, moderate risk stocks. They're not really piling into really low risk defensive stocks yet. And they're not getting out of high yield credit to a large degree. And so it's really just those isolated pockets that really just got overvalued and kind of went too far through, probably March or so this year, and have now had to correct. That you're really seeing a lot of the weakness. The overall market, the S&P 500, most of the indexes are still at or close to their highs, and that's typical of a rotating market, not a overall weak or bear market. What
about value versus growth? It seems like the high beta risk assets are going to go down, but what are risk assets? A lot of people think about cyclical value stocks, like let's say a copper miner, a steel producer, as a pretty risky speculative stock because it needs the economy to do well for the stock to do well. Unlike Apple, let's say, unlike a safe stock, a consumer staple like Coca-Cola. No matter how, if you like Coca-Cola, doesn't matter how the economy is doing, you're going to buy Coca-Cola. You're going to buy toilet paper. You're going to buy Kleenex and the like. But what about specifically the growth stocks versus value? Because we're in this period of a risk-off period, over the next 6 months. But the cyclical stocks are doing very well. In fact, this week, just year to date as of January 6th, energy companies are up like 7%, and ARKK, the growth names, are down something like 10%. Do you think that will continue, or is that just sort of a unique factor of the first week of 2022?
Well, I think there is certainly some rotation or kind of portfolio repositioning that goes on around the end of the year and the beginning of the year. And so whatever people came into the year, heavily overweight, sometimes they'll look to, to scale back. So the selling and technology that had done very well in October, November, December on a relative basis, they're pulling back from some of that and rotating into the areas, like value and energy. And also the fact that energy prices, the crude oil prices and things like that, have held up pretty well, even though there's been signs of growing output, both in the U.S. and from OPEC. So I think energy in particular has a certain amount of tailwind to it from its underlying commodity. That's true for other commodities as well in certain areas within the material sector and things like that. So they still have a strong economy behind them, and they still have the kind of supply-demand imbalance that helps them for a while. So that's why we're still seeing upward revisions in energy stock earnings and things like that. But in terms of the overall kind of style rotation, it's been very mixed between oscillating between growth and value, as long as you're looking at kind of the major large cap growth and value. When you get down into the smaller cap names, like those archetype names you mentioned, those kind of are kind of a bucket unto themselves in the sense that they don't have the kind of the underlying fundamentals to drive them the same way that a lot of the large companies do, and rely on liquidity and sentiment primarily to drive them, and that's what's really been changing. So among the kind of large cap index drivers, I would say it's been very much kind of a back and forth rotation between growth and value and cyclicals and kind of non-cyclicals. But then among the more illiquid names, you're starting to see some of those big holders having to get out, and redemptions and some of that kind of more tactical portfolio level activity going on. I think that's what you're seeing there is more of that kind of going on under the surface among the smaller names.
And how do you think the value factor will perform over the next 3, 6, 12 months? And then the same for size and quality and beta.
Right. So I think value has been doing relatively well overall, and I think will probably hold up. I think energy and financials are the two big kind of weights in that area. I think financials are probably facing a mixed set of headwinds and tailwinds. Energy's probably got some decent tailwinds for now. I think with energy, something like that, the issue is more right now. Things look fairly good. Oil prices and natural gas prices are high, and they've got demand coming back as people kind of recover from COVID. But on the long-term basis, on a 5 or 10-year basis, a lot of people are figuring that demand for fossil fuels is just going to be on a sort of a continued downtrend, and maybe they don't want to make big long-term investments in those kinds of things on a structural basis. Whereas growth stocks, technology, communication services, some healthcare, those are probably going to be long-term winners, but a lot of them are expensive. They've had big runs. Some of them are so big, you wonder if they can get much bigger, or if they'll face government scrutiny, antitrust, things like that. So I think those are kind of the big picture things that are balancing them out to some degree. But I think there's still a lot of money around in the system that needs somewhere to go, and fixed income is very unattractive still. So it's going to rotate amongst the areas within the equity market back and forth depending on the day-to-day, week-to-week economic data and and kind of market sentiment. And I think as long as fiscal policy and monetary policy are at least relatively supportive, they don't become too tight too quickly, a policy mistake, then I think the market and the economy will hold up this year. And I think things like value that depend on the economy can hold up as well.
Mm-hmm. So that's value. What about size? Do you think Apple is going to outperform some $600 million stock that we've never heard of?
I do think that large caps are probably the place to be for this year. That model I mentioned to you earlier when we were talking, my cyclical model on small cap, large cap allocation has moved from kind of early cycle to kind of mid cycle type indicators. You can't really say, if you look at most of the market or the economy, economic data, that we're at near a trough, kind of a low point in the market or the economy. We're definitely, the markets are near highs, credit spreads are very low. The GDP growth has recovered. All those kind of traditional indicators of growth in the economy are far from where they would be coming out of an economic low, and are much closer to levels you'd see near an economic high. That doesn't mean they're going to go down. That just means that that kind of early stage has now likely passed, and we're kind of in the mid-cycle stage where you tend not to get paid for the risk of small caps as well. Small caps are almost always riskier than large caps, and are especially so now that they're more volatile. And so you need to be expecting a premium to be willing to own them, to take on that extra risk. I don't think you'll probably get paid for that risk on average, going forward. I think just kind of the best times for them have faded. There'll always be some small caps to buy, of course, but I think you're going to be better off in the larger names overall.
And I read in your report that small caps, that is small stocks that have a small market capitalization, they did well in 2021, not because they were small caps necessarily, but because they were more volatile. Because it was a risk-on thing, the more risk you took, the greater your reward. How do you think that the more volatile stocks will trade in 2022? So we've seen a little bit of a preview over the past 3 days.
Right, and that's actually been going on for a few months now, is that the most volatile stocks, meaning just volatility for volatility's sake, have been lagging. And that's one of the things that shows that, the risk appetite in general, that's kind of a signal that people are not quite so willing to just take on risk for the sake of risk as they were, in late 2020 and most of 2021, or at least the first half of 2021. And so that tells you that there's a little bit of a pullback in risk appetite, and that volatility per se is not being rewarded anymore, and probably won't be going forward, because again, that's very sensitive to liquidity conditions and sentiment. And it's hard to say that sentiment's going to get a whole lot more bullish than it already is, and liquidity is probably not going to improve dramatically from where it is. It could get worse if the Fed decides to tighten a little faster or things like that. So those things that are very sensitive to liquidity are probably not going to do well, and already aren't doing well, and probably will continue to do so for a while longer. Now, other forms of risk in the sense of cyclical risk or kind of beta itself, meaning sensitivity to the market, is a little bit different. That's actually been doing relatively well. So the big cap stocks, Apple and things like that are closely tied to the indexes, and they attract a lot of that index money and things like that, they'll actually probably hold up relatively well, because people still want to be in equities. They just don't want to be in things that are just, super volatile, kind of for volatility's sake. And so I think stocks that have earnings and that have growth, some, prospects for growth, but they're a larger cap and more liquid and don't depend on that sentiment and liquidity so much, are going to be the places to be. So not necessarily defensive, but not fully, small cap, high risk, stocks that did well first half of last year.
And how are you thinking about global stocks? Mostly we've talked about the stocks in the U.S. Emerging markets didn't really do that well in 2021. Everyone was saying it's reflation, and all the signals of reflation were there. High commodity prices, high growth, yada, yada, yada. But in reflation, emerging markets tend to do well. The dollar tends to be weak. That was not the case in 2021. How are you thinking about emerging markets as well as China and Europe? And specifically, China's had a huge sell-off. So how are you sort of evaluating the risks and rewards there?
So I'm still fairly negative on China, just because we haven't seen a turn in the earnings estimate trends that we watch there for China. They're still much weaker than the rest of the world. So it still looks like analysts are not through bringing down their estimates for Chinese stocks. So I would say that that some of the bad news has clearly been priced in, that they've underperformed a lot, but I haven't seen a turn in the fundamentals or the top-down policy that would say, okay, things have really changed, and therefore there's more of an all clear to get back in. China, in particular, of course, I guess starting sometime last year, had a policy change to go after some of the big popular tech companies, education companies, property companies, to try to crack down on them, have more control. Whatever their policy directives were, it hurt their earnings and made things worse for shareholders of those companies. So, and of course, China is, I don't know, roughly maybe a third of the overall emerging markets universe by weight. It's a huge part of that. And so when China decides
used to be
to
more,
change
it used to be like 40%, but then it performed so poorly. Now it's only like 30%.
Right, exactly. So, so having that much weight in China and having them be such a dominant influence, the fact that they not only had the response to COVID that they did, but also the kind of policy-related change, going after certain companies and essentially, telling them to make less money, and they did. So, so that's had an effect on the overall emerging markets kind of universe. Other emerging markets have struggled as well. Brazil's had a hard time. Turkey, of course, has been in the news a lot lately, having a hard time. So there's definitely been pockets of other sources of weakness within emerging markets that are more idiosyncratic or specific to those particular countries. The rest of emerging markets outside of China are looking better than they were, for sure. So I would be, if I had to get some exposure there, I would look for non-China EM, to kind of to look more closely at. But again, as you start to see the Fed and other central banks no longer providing as much liquidity, that tends to be sort of a headwind for emerging markets in general. And not all of them benefit from higher commodity prices. Some of them are oil importers and have to pay higher prices for oil and natural gas. And so I think you have to be much more selective now within EM rather than buying kind of the overall emerging markets asset class. So if you think that the risk appetite is starting to fade, liquidity is starting to fade, and you have the heavyweight of China still kind of putting their thumb on things, I think it's still risky to dive into emerging markets in general and China in particular right now. I don't think it's been fully, because China stocks, by my metrics, their forward earnings PE ratios are not particularly cheap. They've underperformed, but they're not especially cheap relative to their historical norms. So you can't really say all the bad news is priced in because they're at really low multiples relative to where they normally trade. So I would still stay sort of cautious on those areas for now.
In Europe?
Europe looks pretty good in terms of relative earnings revisions, sort of the relative fundamentals. It's a more cyclical region, so the more cyclical sectors are more heavily weighted there. They don't have as big a tech sector in Europe, so if you're heavily dependent on technology to drive things, that's a very U.S. kind of focused bet to make. If you like tech, you have to like U.S. If you're a little more balanced on tech, or you're more willing to take cyclical risk, then Europe actually looks pretty good. And they look like they probably won't be raising rates and tightening liquidity quite as quickly or as aggressively as the Fed will. So you'll probably still have some of that policy support there as well. So I'm relatively positive on Europe, more the Eurozone, continental Europe, than the UK. Because UK is still facing a lot of headwinds from Brexit and things like that, as well as COVID. But I think Europe is relatively looks relatively favorable in our work.
Sam, a lot of viewers may be hearing your analysis and saying, "Hey, Jack, you had someone on a few weeks ago, and they were saying the exact opposite thing, that the cyclical stocks is what you want to avoid." I think what's key to understand is, number one, obviously, it's great to have a diversity of views and analyze them on their own merits. But secondly, and most importantly, your macro analysis that you just laid out is not the fundamental driver of your predictions and your research. What we have just talked about is really just a preview. Now let's get into your bread and butter of your analysis, which is MAER. So what does MAER stand for? And let's get into it.
Sure, no, that's right. Yeah, a lot of the work is kind of driven from this bottom-up kind of set of indicators that I watch. And you're right, MAER is kind of the acronym that I use. It's MAER is the acronym, and it stands for the Monitor of Analyst Earnings Revisions. And that was the original name of a product that was developed many years ago, and that I kept when I kind of relaunched it in 2013, I guess. And it's designed to track what analysts are doing in terms of their earnings estimates for individual companies, and then aggregate it to industries, sectors, countries, and regions to get a feel for where the kind of bottom-up fundamental trends are for companies and for larger aggregates, as a measure of where the fundamental momentum is, essentially. So everyone can look at prices and see where price momentum is, but knowing where the fundamental momentum is, where the actual earnings are either supportive or not supportive, really helps tie everything together and gives you a kind of a bottom-up view of things to go along with the traditional top-down macroeconomic data that you might look at.
Okay, so stocks have earnings, or they have negative earnings, and analysts, people who work at banks and other research shops who work for investors, essentially, they put out forecasts, estimates of what a company's earnings are going to be. Oh, Apple is going to earn $1.50 per share. Oh, actually, but they change. And they say, actually, I'm moving it from $1.50 to $1.60. Your framework, MAER, Monitor of Analyst Earnings Revisions, says the fact that this analyst moved from $1.50 to $1.60, that's bullish. Why is that the case?
Right, yeah, no, I think that's the key, is that analysts around the world produce their estimates for thousands of companies, and publish them. And so that's what I'm sort of tracking here is what Wall Street and global equity analysts are doing with their estimates for earnings for all these companies. And here we're mostly looking at what they're going to earn over the next 12 months. That's the primary kind of time frame we're looking at. And what we found, and what most research over the years has found, is that the level of estimates, or kind of where people are, what they're predicting today, is less relevant for forecasting stock prices than the changes in the estimates, the revisions to, or the updates to the revisions, the news that's impounded in them, because what they're saying today is pretty much already priced into the stock. So the PE or whatever it is will reflect current earnings. But when they see some kind of new development, new news, Apple announces a new product, or there's a new regulatory change, or something happens that causes their view of what the company's going to earn to change, that's the piece that will move the stock price typically. So when an analyst raises their estimates or lowers their estimates for a company, and particularly when they do it as a group, stock prices respond to that. You can show statistically that stock prices respond to earnings estimate changes when they occur. So stock investors do follow what analysts say about their earnings estimates, and particularly those changes. And that's why the revisions are key, that the changes are what really move stock prices. And so when you want to see what's going on for a stock or for a group of stocks, looking at which direction those changes, those estimates are moving, is really kind of the crucial bit. And that's what MAER is designed to track kind of in a structured and coherent manner over time and amongst many stocks.
And these analyst revisions, how forward-looking are they? I should say is that are they responding to news that has already happened? I'm going to take a guess that in March 2020, let's say on March 23rd, the bottom of the S&P 500, analysts were still downgrading their expectations when actually that was the ideal buying opportunity. So we've spoken earlier about this, how your model is better at identifying whether a trend will continue than identifying that the trend will start. Because analysts, can you speak to this also? Because analysts, they're not like traders who are, they get a commission essentially on how much money they make. They're salaried people and they're trying to keep their jobs. So if I'm an analyst and I forecast that Amazon is going to make $80 and it's way outside the norm and they only make $60, that would look bad for me, look bad for my firm, so that might not be good for me. So analysts typically, I have this prejudice, I don't know whether it's true, and I have this sense that analysts sort of hug the index. So if it's you at another bank, you forecast 160, I'm forecasting 161 and it may be 159. Sort of how do you think that these human analysts who are forecasting and making their own mistakes, how is it that it results in greater returns?
Right. So you definitely have to take into account kind of, where these analysts, how they behave, what they're doing, what their incentives are when you kind of analyze this sort of data. And you're right. I mean, analysts do have incentives to, be close to say what the company guidance might be, or what their own internal bank or brokerage firm is telling them. Investment banking has a lot of overlaps with analyst activity. So there's definitely a lot of things that can influence what they do. And that's part of the reason why analyst ratings, the buy, hold, sell ratings that they issue, are not part of my analysis most of the time, because those tend to be much more kind of skewed and can be sort of political in some sense, and have a lot of incentive issues. Whereas the earnings estimates tend to be a little bit more sensitive to what they really think, and they'll tend to move their earnings estimates before they change their buy, hold, sell rating, which tends to move more slowly and kind of in a lagged fashion. Now, even the earnings estimates themselves, analysts won't always be right there on the day that the stock bottoms or that things are really turning, because they have to wait to see if things are really actually changing and what they hear from the company, what they hear from other companies, and kind of triangulate to find out what's really going on before they go and start moving the numbers around. But I would say that once they start to move in one direction, particularly if they do it as a group, they tend to be persistent in doing so. And because there are fundamental trends in business that, once a company starts to do well and has a good product and people like it, there's usually not just a one-off thing. There tends to be a trend in sort of more favorable, business for that company or for that industry. And so analysts will pick that up. And so that's why tracking what they do to the revisions to the estimates are the most sensitive way of tracking how their view on things is evolving. So even if they're not there on the day of the market bottoms, they'll at least tell you which direction things are going as the news, kind of filters through and changes. And so it'll keep you on a fundamental trend, say, and tell you when market movements might not be driven by fundamentals. Sometimes markets move and there's not an earnings related reason for it. And a lot of times those movements will be reversed. It's short covering or it's some other kind of thing that's going on. And so knowing what the analysts are doing can be very helpful, both to see what is happening and kind of what's not happening.
Mm. And what does MAER tell you now? First off, of the stocks in the Russell 3000, the stock that has the #1 rating is very interesting. You told me yesterday, I never would have guessed it. It is Pfizer. Let's use that as an example here. So now we're looking at the monitor of analyst earnings revisions for Pfizer, PFE. Looking at the top chart, what are the blue bars? What are the red dotted line? And what is the black line? And I should say to viewers, this is quite complicated. It took me like 20 tries to really understand what's what.
Right. Yeah. The idea with the MAER charts is to try to, pack a lot of useful information into one chart. So once you get used to looking at them, it's very handy. But the first time you look at it, it's a lot to take in. So don't try to. I would say don't worry too much about the details. But the key thing here is that we're showing a 5-year chart. The black line is the easiest to explain because it's just the relative performance of Pfizer versus the S&P 500. So if the black line is rising, that means Pfizer is outperforming the market. So you can see recently, the most recent movement in the black line shows Pfizer has outperformed. Now the red line is the other kind of key indicator for MAER. That is the earnings estimate revisions trend and what we call revisions breadth. And all that is the proportion of analysts that are raising estimates net of those lowering it. So you'll see on the chart in the top left corner there, it says there are 21 analysts currently that follow Pfizer, that submit estimates, earnings estimates for Pfizer to FactSet, which is where I get the underlying source data. So of those 21 estimates, some analysts will have raised their estimate for earnings over the last 2 or 3 months. Some will have lowered. But if you take the number that raised and you subtract the number that lowered, you get 78%, which is shown next to it there where it says REVBR. That's revisions breadth. And that means that net 78% of those 21 analysts have raised their estimate over the last 3 months. And so that red dotted line is basically just a cumulative sum of those monthly revisions breadth figures. So if the red line is going up, that means there's more analysts raising than lowering, which is a good sign. And the steeper the line is, the bigger the percentage of analysts that are raising is, meaning the more, the bigger the agreement among analysts is in terms of positive versus negative. So what you want to see, if you're bullish, is the red line going up steeply, and then the black line typically will kind of follow along in terms of relative performance. Now the blue bars are the percentage change each month and how much the analysts have raised their estimates. So if you look at the numbers there at the top of the chart, they have raised their estimate for 2023, or 2022, I should say, this year, 22% in the last 30 days. That's a really big increase to $6.13 a share.
Yeah, so high that it's not, the blue bars only goes up to 10%. So 23%, 22% is very high.
That's literally off the scale, yeah. And particularly for a big company like Pfizer, that's very unusual to see a single calendar month where analysts have changed their estimate that much as a group. A 20% move in a calendar year estimate is big. And so that little bracket 98 there in the very top right corner, that tells you that movement, the 22% movement in the earnings in a month is 98th percentile for Pfizer over the last 5 years, meaning that's one of the biggest month-on-month moves that Pfizer's seen in many years. And actually, probably last month or the month prior might have been the only higher time. You can see those last 3 bars are all, chopped off at the top. They're all as big as they can get. So it's basically told you the analysts have dramatically raised their estimates for Pfizer over the last few months, both in terms of how many analysts have raised and how much they've raised. So those are the 2 main components of MAER. How many analysts are raising estimates and how much they've raised them, the magnitude, the breadth and the magnitude. And that's really the key driver there, is that the fundamentals are clearly getting better in terms of the underlying earnings story for Pfizer. Now the black line has gone up. That means that the stock has responded. It's outperforming the market. And so that green line in the middle is a rolling 6-month price momentum indicator. Now it adjusts for the stock's beta, size, and style to try to, kind of remove the effects of the macro market trends. But the important thing is that it's above zero and well above zero. So that tells you that the stock is outperforming on a risk-adjusted basis by a wide margin. So that's also strong. Price momentum tends to persist in the intermediate term as kind of a well-established quantitative result. So it's got strong earnings momentum. It's got strong price momentum. And in the bottom section there is the valuation, the relative valuation of Pfizer versus the U.S. large cap S&P 500 universe. So you can see that the purple line there has been going down, which means the stock has been getting cheaper relative to the market. And so whereas at the beginning of 2019, for instance, Pfizer had a forward PE multiple that was just about equal to the overall market, about 1 times the market multiple. Now it's actually slightly below half of the market multiple.
Yeah.
So it's maybe
like
10 times
9.
earnings.
Yeah,
like
right.
That.
It's like
9 times earnings.
So right now, Pfizer is trading at what analysts forecast Pfizer will earn in 2022, which is $6.13. It's like 9 times that. So that is a pretty good deal for something that's, typically it's riskier stocks like copper miners or real estate financial stuff that trades at low multiples like that. So that this is why Pfizer is number 1 in your MAER ranking in terms of in the Russell 3000. Okay, so a little confusing for people who are seeing this the first time, but stick with us. Now let's look at one of the worst ranked stocks, which I think is interesting to a lot of people. It is Peloton. Peloton ranks as one of the worst stocks in the Russell 3000 in terms of MAER, Monitor of Analyst Earnings Revisions, and it has done extremely poorly. It was a darling of the early COVID boom when everyone was staying at home and wealthy professionals were buying these extremely ridiculous bikes. But since then, it has suffered extreme drawdowns of something like 70, 80%. So again, here we have the black line is the relative performance relative to the S&P 500. Tell us about what you're seeing on this chart.
Right. So in some ways, this is sort of the opposite of what we saw in Pfizer, where if Pfizer had strong earnings revisions, strong price momentum, and very cheap valuations, Peloton is the opposite. Of the 30 analysts that cover Peloton, more than about 2/3 of them net are still cutting their earnings estimates, and they're cutting them by significant amounts. Now, as you kind of alluded to, Peloton is a money-losing company, so its earnings estimates are negative. So they're forecast to have losses both this year and next year. But the size of those losses has actually been increasing in terms of our analyst forecast. They're expected to lose more money now than they were a few months ago. So that means that valuation for a company that's losing money is kind of, there's not much to say about it. The earnings are negative, so it's hard you can't really have a price earnings multiple for it. But the price momentum has certainly been extremely negative, as you mentioned. So and that actually started really almost a year ago. And so if you can see in the chart, the red line had been quite positive up until early 2021 when everyone was buying the bikes and staying at home. And kind of early 2021, it's about the time the stock price peaked, but also about the time the earnings revisions peaked. So analysts started to become much less bullish on the earnings prospects for Peloton about a year ago. And so they started to get negative and then got progressively more negative. And then really the last maybe 6 or 7 months, it's been severely negative in terms of most of the analysts have been cutting estimates, and they've been cutting by large amounts, and the stock has been underperforming. So there's been some company-specific things going on. I'm not an expert in Peloton itself, but certainly it's made headlines for some of its its missteps, and the fact that people are just coming back from COVID and not buying stay-at-home stuff quite as much. It's really been kind of a poster child for that reversal. But it's maybe had some company-specific missteps as well. But it's it's got all the things that Pfizer doesn't in the sense of having no earnings, but also having increasingly large losses forecasted and very weak price momentum. So it tells you that analysts are not through cutting estimates yet, There's been no change in the fundamentals that would tell you that even after this big decline, it's time to pile in and buy because the stock is cheap or everyone's all done cutting their estimates. There's no sign of that yet.
Okay, now let's look at the biggest stock in the world, Apple. Recently made a market cap of $3 trillion, a record. What are we seeing here? To me, the red line, it looks like analysts are upgrading. The breadth looks good. It looks like analysts are upgrading thing, and yet Apple ranks pretty much smack in the middle in terms of MAER for the Russell 3000. Why is that the case?
Right. So Apple does still have net positive revisions. So the red line is still rising, but as you can kind of see from the red line there, the slope has kind of come down some. So it was rising steeply up until a few months ago, and now it's rising at a much more moderate pace. And so you can see that the number there, the revisions breadth figure, is 16%. So there is a majority of analysts that are raising estimates, but it's kind of a slimmer majority now than it was during most of 2021. So that means that it's not as decisive a revisions trend as it used to be, or that some of the other companies in the market right now are seeing. So if Pfizer had 70 or 80% of their analysts raising estimates, Apple is a much lower figure, still positive, but 16% is definitely not as strong as some of the other stocks that we've seen. You can see right now, and the same thing for those blue bars. You can see there were really big blue bars, meaning big month-on-month changes in the consensus estimates for much of last year, certainly the first half. And now the blue bars have gotten smaller, meaning that the changes, the earnings upgrades, are just of smaller magnitude. They're 0.5%, maybe 1%, as opposed to 2, 3, 4, 5% last year on a month-to-month basis. So it's still positive, but less so than before, and less so than some of the other companies in the market right now. The price momentum is still pretty good. It had a pause for a little while, and now it's taken off again. But you look at the multiple; it's at 1.3, 1.4 times the market multiple, which is higher than Apple normally trades. Over the last 5 years, it's been much more kind of around the market multiple or a little higher. So the 28 to 30 times earnings it's trading at is a pretty good premium for Apple. It normally doesn't trade that high. So it's kind of expensive relative to where it normally trades, and the revisions aren't as strong as they used to be, or some other companies. So that kind of puts it in the middle. It's not the best, but it's also not negative. So that's why it kind of ranks in the middle now.
And Sam, how are you thinking about the earnings seasons that's approaching? We're filming on January 6th. It starts pretty soon, right? I know the bank starts reporting somewhere in like the 15th to 16th. What is the activity looking like?
So I think you'll start to see more activity coming up, and then starting in a week or two, and that will drive more of the MAER activity. But going into earnings, estimates are still generally rising. They're still net positive overall, I would say. And so I think you're probably going to see generally good results for Q4 2021 overall. And it's been probably 6 quarters now in a row we've had really strong beat rates, meaning the actual reported earnings come in well ahead of what the analysts were expecting for that quarter, much more so even than normal. And so because they've been more, because as things have developed with COVID, analysts have kind of been catching up and been too conservative with their estimates, and have now finally probably gotten a little bit more closer to where reality is. So I think you may not see quite the same beat rate, but it'll still be pretty positive. And then we'll have to see, do earnings estimates go up after that? Meaning, do analysts see what the companies say and raise their estimates further for looking out into the first, second, third quarters of this year?
Yeah, so there's a gamesmanship. Analysts want to have a good relationship with the CEO, the investors, so they have a systematic pattern of lowballing by saying, actually they think it's going to 160, but they actually say it's 150. So when 160 comes out, it's a beat. So the stock goes up because it's a good big of expectations. You're saying, and correct my data, because I know what you're talking about, but I forget the exact percentage. But something like the historical beat rate is 70% because of that gamesmanship. But in 2021, it was something like 80, 85%, right? Somewhere around there?
That's right. Yeah, the historical average, is probably 65 to 70%, kind of as a typical beat rate on a quarterly earnings, reporting cycle, because analysts kind of want to make sure that that the companies can beat. But the last 5 or 6 quarters, it's been around 80%, which is much higher than average, and is much more than just kind of that kind of gamesmanship would explain. So I think analysts really were surprised by the strength in earnings. And to some degree, I think the companies themselves almost were surprised by how things have turned out relative to what they might have expected, given what was going on with COVID and everything else. And again, that's kind of the historic nature of the stimulus that occurred and the vaccine development, all these things that have happened faster than everybody expected them to.
Yeah, and this is a really important point, which is that earnings in 2021 were phenomenal. They were phenomenally, like people who say, "Oh, the stock market's in a bubble, it's all manipulated," they may be right. But setting that aside, the simple fact is that there was very strong, robust earnings growth. So much so that for the S&P 500, which is began 2021 in the beginning with a three digit, now it's at 4,700 or something. It made about, I think, $205 for that. So PE multiples actually contracted over 2021. They did not expand because earnings themselves grew. Can you tell us about what analysts are forecasting for 2022 earnings? Not specific stocks as we've gone in, but specifically the S&P 500. I've heard that analysts are forecasting earnings to grow at a pretty rapid clip, but they expect earning multiples to contract. So their forward estimates of price is somewhat moderate.
That's right. Yeah. No, 2021 was definitely a year when earnings grew somewhat faster than the stock prices did. So as well as stocks did, earnings actually did even better. And of course, that's partly recovery from the depressed levels of 2020. But estimates basically were rising all year, which is unusual. Normally, estimates come out. Analysts start the year with very optimistic, kind of bullish estimates for the following year, and then as reality kind of sets in, they trim them down to more realistic levels. In 2021, they actually were too conservative and kept having to raise numbers all through the year, which is very much not the typical pattern for a typical year. It is more typical in the very early stage coming out of a recession. It was just even more so or last year. 2022 is looking more like probably a more typical year when earnings growth will be, positive, but not, double digit, not the sort of 20, 30% increases that we saw in 2021. So I think the S&P right now is analysts as a group are forecasting about 9% earnings growth for the index for 2022 right now. And so if you think multiples will stay the same, that would imply that the market will be up around 9%. If you think multiples will contract, then you'd get something less than 9%, for the calendar year. If you think multiples could expand, then you might get more. So if we're around 21 times earnings now, you can then make your projection about where you think the PE ratio for the market will be at the end of next year. The question, from my standpoint is, if they're projecting 9% growth now, does that number go up from here, or does it fade? Does it wind up being 6%, or does it wind up being 12? If it continues to rise some and winds up being 12, then you could still have a really good market year, even if multiples don't expand anymore.
Sam, what does MAER indicate about the favorability of specific sectors and industries? I know consumer staples, the sort of risk-off sectors, consumer staples, healthcare is near your bottom, and energies and financials remain at the top. Tell us why that's the case.
Right. So for a while now, the traditionally defensive areas like consumer staples, utilities, and to some degree healthcare have been sort of at the bottom of the relative revisions ranking, meaning that the analysts have not been raising the estimates in those sectors to the same degree that they are in the more cyclical or some of the large cap growth sectors. So technology has had good revisions. Energy recently has had very good revisions, and of course a lot of that is driven by oil prices. Financials have had strong revisions because mortgage activity has been very strong, and the markets have been very strong. So they've all had capital markets benefits from that. They've had growing credit demand recently, so there's been some tailwinds for that sector. Some of the consumer areas have done well. A lot of retail spending has been going on, particularly after all the stimulus we've had, but not all of them. And then things like industrials, some of those kind of traditional cyclical sectors, some have been very strong, some have been very weak. Certainly things like airlines and travel-related areas have been very weak due to COVID. But things like air freight and shipping have been very strong because everyone wants their packages, and there's a lot of supply chain issues that have made bid up the price of being able to ship things. So you've seen some divergences within certain sectors where they're sort of split, and then other sectors have been fairly strong overall. But you definitely do see some of those more cyclical areas holding up relatively well relative to the kind of traditionally defensive areas. They can't keep up, and some of them, like consumer staples, have had supply chain issues or cost input pressures from energy and things like that, packaging costs. Those hurt some of the consumer staples areas, things like that. And healthcare, of course, if you make a new vaccine, that's great, but a lot of the elective surgeries and things like that, spending on healthcare that would have occurred has not occurred because it's been diverted to COVID and emergency rooms and things like that. So the healthcare sector, the private sector that we track, much of that has actually not had good earnings revisions and relatively weak fundamentals because a lot of the money's been diverted from where it would normally have been spent towards COVID.
Can you quickly talk about the shipping stocks that known as the marine industry, where you have companies that with their forward price to earnings ratios are something like 2? So seems like one of two things has to happen. Either those earnings revisions have to be wrong and they don't make money because shipping bulk freight costs go back down, they mean revert, or the price has to go way up.
Right. And those kind of companies are kind of the, textbook example of an extremely cyclical industry. Some years they make lots of money and some years they lose lots of money because they're, very, long-term asset, heavy things. It's hard to build a new ship very quickly, and they tend to get booked a long time in advance.
Right. And last year they just printed money, right?
Right. So, everyone needed, things shipped as things recovered last year, and there just weren't enough ships to go around, particularly, coming from China to the U.S., things like that, certain shipping routes, demand for all kinds of both, finished goods. Getting a washing machine was hard, but also getting iron ore and things was hard. The prices for those things went up, so people, spent more on shipping them. And so anyone who has a bulk freighter over the last year or so has seen huge demand. We've seen all the Baltic Dry Index and all those indicators of freight costs have skyrocketed. Which, if you're on the side paying that's bad. Which is why some of those industrials and consumer areas have been hurt. But if you're the one that's actually getting that money, then you're making huge profits. But I think most investors realize that those kind of boom times are not going to last forever. So you're not going to price the stock as though those earnings are going to last multiple years into the future. So it's great to have it for this year or next year, but 5 years from now there could be another oversupply, price go back down again, and you have to assume that earnings are going to be very cyclical and fall at some point in the future. So the multiple on this year's earnings is very low, but maybe on the long-term future stream of earnings, it might be actually much more moderate, assuming kind of mean reversion in the pricing and the earnings for those stocks. So yeah, they look very cheap right now, and they've had very strong earnings revisions. Some of them have done very well, but you can't assume that's going to go on forever. I think that's how the market's pricing them right now.
Right, and there's always that value trap thing where cyclical companies look the cheapest right before they're going to crash. Like if you look at ExxonMobil, oil energy companies, price to earnings ratio, it looked the cheapest in 2007 because even though the stock had gone up a ton, earnings were just incredible. But obviously it's been a very, very bad investment since then. Except for 2009 and 2014. But yeah, viewers are interested. I think there's we can put up a list of the shipping stocks that are the top rated MAER by USAM, and then if they don't individual stocks, I think there's a new ETF with the ticker great name BOAT, BOAT. Sam, I want to ask you, analysts' ability to identify whether a trend will continue is strong. That is the premise on which your MAER framework is based. What is their ability to identify whether a trend is going to end? How do we know if they continue to upgrade earnings and in particular industries? What is their track record of actually that going true? For example, going back to previous recessions, what were analysts forecasting in 2007? Were they rosy, and were those rosy expectations obviously ended up wrong, or were they correct in foreseeing a drastic slowdown in profits? And it doesn't have to be just 2008. Other areas where a downturn was 2020, for example.
Right. No, I think in aggregate, overall, analysts as a group are not going to pick, the tops and bottoms in the economic cycle, particularly when they happen, more suddenly. Like certainly 2020 was, an obvious example of that. Now, earnings estimates going into, in early 2020 actually weren't that bullish, meaning estimates have been sort of, flat to down going into that because the economy was actually slowing in 2019, if you remember. And the Fed was already cutting rates starting in the middle of 2019 because things had been sort of slowing down going into 2020. So before COVID ever showed up, there was a kind of a weakening pattern. But no, in 2007 and 8, they responded to the news, but they did not anticipate the full economic cycle ahead of time. And analysts, because they're focusing on individual companies, most of them are not really sort of paid to forecast the macroeconomy overall, and they're only tasked with forecasting earnings for their small list of maybe 10 or 20 or 30 companies in one specific industry typically. So you'll have an analyst that covers just semiconductor stocks and ignores all the other companies. And so that's why it's useful in some ways to look at all of them as an aggregate to see what's going on, even though the analysts themselves are not following all the stocks individually. So yeah, at major turning points in the economy, analysts will typically be kind of late to downgrade and then to upgrade. And so we certainly have to take that into account when you're looking at the pattern of earnings revisions in aggregate. So it tends to be much more of a relative decision, meaning which sectors or which stocks at any given point in time have stronger or weaker revisions. That relative view tends to be a much better thing for analysts to be able to add value for. And actually, even within a sector, if you ask an energy analyst where oil prices are going to be, he or she may not know any better than you or I would, but he can tell you whether this particular company is going to benefit more from higher oil prices than that company will because of their hedging practices or their, whatever they're doing at the company level. So if you want to know which energy stock to buy, which ones will have stronger revisions or weaker revisions, they're actually very good at that. And that's where their MAER tends to really do the best job, is on a relative basis among a list of stocks, which ones are likely to outperform the other one, rather than kind of the overall macro where earnings going to be a year from now, because that's just very hard to forecast because there's so many macro things that can change in terms of policy and Fed and things like that analysts aren't really paid to forecast and can't do. As a rule, some can, but overall, that's what they're really best at, is kind of the relative view of which stocks within their space are going to do the best, and that's where the earnings revisions really shine.
Yeah, and how potent would you say earnings revisions are at this point in the cycle? I imagine there are times when the macro isn't really doing anything, pretty sleepy time in markets, when earnings fundamentals and revisions are what matters the most. There are other times, like in March 2020, then the earnings revisions didn't play as a role because there was this huge gyration in the markets. Right now, I mean, what do you think the odds are, let's say, that consumer staples continue to have really bad earnings revisions and energy companies continue to have really good earnings revisions, but consumer staples outperforms energy because investors are rushing to risk off sectors and they're like, I want my Coca-Cola, I don't get me away to this copper mine,
Right, and that is very much what we've seen historically, is that during periods of major macroeconomic changes, big kind of panic periods, or COVID, when there's a major kind of global macro event that happens suddenly, and then the policy responses to it, analysts' behavior, what they're doing with their estimates, is just going to be less relevant to investors. Because if it's all risk off, and I just want to get out of stocks and I'm panicking, and I don't care what the earnings are, I just want to be in cash and be safe, then yeah, it doesn't matter what the analyst says, plus or minus a little bit on the earnings. And during those times, certainly in March, April 2020, most stocks had negative earnings revisions. Almost all the stocks had, estimates that were being cut. Same thing with, September to December of 2008. It looked like the world was ending, and everyone was cutting estimates, everyone was selling. Everyone was waiting to see what the Fed or the federal government would do, and that's all that mattered. It was just pure risk on, risk off, and subtle decisions about which sector and which stock are going to do relatively well didn't really matter for that time.
Sorry, and that was in between. The analysts started becoming really bearish. I'm going to take a guess after the market had topped, but before it had bottomed, right?
Right.
Yeah.
They had been cutting estimates, in 2008, but yeah, then they saw, Lehman and all those things happen, and then, really cut estimates. And then once the Fed came to the rescue in early 2019, then they did start to raise estimates. But yeah, the market will tend to move faster than the analysts will when you get those major macro turning points. And that's when, analyst behavior and fundamentals in general, even valuations, don't matter as much in those periods. So when you have those really intense kind of risk on, risk off periods, that's when relative performance of earnings revisions or P ratios or anything else are just not going to matter as much, because it's all investors care about for a little while is risk on, risk off. And once that kind of passes, and usually they don't last that long, then you get back to sort of fundamentals again. So I would say, 80+% of the time, things like earnings revisions and fundamentals matter. During those kind of panic periods or just after, when it's all macro policy and all risk on, risk off, then yeah, you have to just pay attention to the macro, and not focus as much on the individual company stuff.
And let's go over a few more companies that, people may think, oh, the bloom is off the rose, let's say, on a home building company like Lennar. We had a huge real estate boom shortly after March 2020. People say, oh, that's mostly over. The easy money's already been made in Lennar. Your model says no. Lennar is ranked number 10 for MAER in the Russell 3000. Just tell us a little bit about why you think that's the case, and also you as an analyst are more than your model. There are certain times when you say my model's telling me this, I trust my model. Other times you're saying my model is saying this, but in my experience, let's discount the model a little bit because something else is going on. So how are you thinking about these like really high beta sectors, whether it's home builders, miners, as well as not to mention the technology? Sort of like how are you thinking about this market?
That's right. Yeah. No, I mean, any sort of quantitative process is going to have times when you have to kind of override it a little bit, or at least be aware of what its limitations might be. There are no silver bullets, and certainly things like earnings revisions where there can be other reasons why analysts do what they do, or macro cyclical effects that will override them. And so yeah, so home building is something that's been doing very, very well for a long time. And the earnings revisions for Lennar, I'm just looking at the chart at the moment, have been basically in a straight line up for more than 18 months, certainly since kind of early 2020, and still are. I mean, the estimates are up 8.5% just in the last month for that stock, after having been up for a long time. The stock's done well, but not extraordinarily so in recent months. And the multiple, sort of a little bit like those shipping companies we were talking about a minute ago, has come way down. It's trading at something like 5 times earnings. Again, because people assume, this is the boom time. There's going to be a less boom or a bust time, coming at some point. You can't assume that home builders are going to make as much money, over the long run as they are right now. And I think that's very much the case. Now, does that mean you should sell them all right now? Not necessarily. If it's still got strong revisions, meaning the analysts are still finding reasons to raise their estimates, even after having raised them consistently for over a year, that means there's still untapped, demand in terms of homes and things that's going on, and so they still might, have a tailwind there. So I would say it's probably you don't want to necessarily get off the train if it's still moving in the right direction, and that's a lot of what the MAER and the industry work is meant to do, is to keep you on trends that are in fact persistent. And then when things start to weaken and go from very strong to less strong to kind of neutral, that will tend to get you out of them, rotate away from them before they really start to to weaken substantially. So you won't pick maybe the very top and the very bottom, but you should get the most of the move, and will avoid the really big, obvious kind of disasters when things are go from bad to worse.
Sam, tough question, very hard to answer. I'm about to ask, but how do you think in Q1 the earnings seasons that is rapidly upon us, where companies report their Q4 earnings for 2021, how do you think the volatility will be? Do you think there'll be times when companies beat earnings by a massive amount, but they still crash because the market just wants to crash. Do you think there are times when they have a huge miss, but everyone just loves a particular stock? And also, is that going to be a time when your model is just switch and switch and switch because so much new data is coming in? Also, what if you speak to any analysts, like what is their sort of emotional frame? Are they ready to downgrade because they've been upgrading for so long, or are they got a few more upgrades in them?
So I think there's still some upside to earnings estimates potentially coming. It's just not going to be huge the way it was last year. And I think it'll be a little more differentiated. It's not all companies going up or seeing their estimates rise. I think it's going to be a lot more selective, even within sectors and within industries. There'll be winners and losers. And that's actually a better environment for a process like MAER, which tries to do that, to try to isolate the winners from the losers, even within sectors and industries. And it's actually been doing better in the last, say, 6 months than it did, say, in the second quarter of 2020, in terms of its ability to relate to stock prices.
Sam, I know you spend a lot more time hitting the data in rigorous analysis than you do in living in the narratives like I do. But what is one narrative that you hear in financial markets that you think is the most wrong, or has the least chance of becoming correct?
I think right now, one of the big things that you see in the news a lot and people talk about is the Fed, and particularly the Fed's balance sheet, the QE story, that all the money printing that the Fed has done over the years is the one true driver of why stocks have gone up and why, stocks do what they do and assets do what they do. I think the importance of the Fed's balance sheet and the QE process, recently, now and looking forward, is less than what people have assumed historically. And even going back to 2008 when it all really started, I think the importance has been overstated. I think it's an important signaling device. It tells you what the Fed is thinking and what they intend to do, but it does not directly drive the returns on a kind of on a mechanical basis, or that's not where the money is really coming from per se. I think it affects the banking system and the reserves in the banking system, which is important, but not the main driver of what Apple is doing, or what companies in general are earning, or how investors behave overall. I think fiscal policy is much more important now than monetary policy, because we're kind of stuck in low rates, and there's plenty of reserves in the banking system right now, and probably will be for a while. So even if the Fed does stop buying bonds and even reduces its balance sheet for a while, that will get a lot of play, and it's a big talking point. I don't think it's really going to matter for the fundamentals that much.
Well, Sam, it's been great having you on Forward Guidance. Been very generous with your time as well as your insights. Final question for you is, what do you think about bond yields, whether it's the 10-year or the 30-year? Growth might be slowing, and yet inflation, which is itself slowing, remains stubbornly high. What's your outlook on let's say, the 10-year or the 30-year U.S. Treasury?
Yeah, my general longer-term view is that the yield probably won't go up that high, meaning that the prospect of a 5% yield on the 10 years or 30 years is pretty remote. I certainly think the yields could back up some from where they are now, but I think the general view in the markets, and that I tend to agree with, is that the Fed's kind of terminal interest rate, say 2 years from now, is probably going to be 2% or less. It's probably not going to be much above that. So if you don't think that short-term rates in the Fed are ever going to push rates up much above maybe 1.5% to 2%, it's hard to make the argument that 10 or 30-year rates are going to be a lot higher than that. And also don't think that once we get past this kind of phase of higher inflation and supply chains and stimulus, when we get back, say, in 2023, 2024, the economy is probably going to be slower. Inflation will come back down. Those disinflationary forces that were in place for years and years up until 2020 are going to kind of come back. Demographics and debt and technology, all those things that are long-term trends will reassert themselves eventually. I think those are all going to keep both the Fed and interest rates in general from going up too high over the longer term. So I think, rates could back up a little bit further from here, but I'm not a massive bond bear on long-term rates because I don't think the economy can handle them, and I don't think the Fed is going to push things that far. So I would say maybe a little higher than here, but not a lot higher.
It's interesting you said, I'm not a big bond bear. you didn't even talk about the other case, which is bond bull. So you don't think yields are going to go down either?
Not right now, no. I think the fact that the Fed seems to be committed to raising rates for a little while means that it's going to be hard for yields to go down a lot, unless you get to the point where people think the Fed has made a policy mistake and over-tightened. We're probably a little ways away from that yet. That would be a 2023, 24 problem probably. So for right now, I think yields, maybe stay in the general broad range they've been in, or bump up a little higher. But I don't think they're going to go skyrocketing. But yeah, I don't think they're going to come down a lot. Given I think risk assets will probably hold up, so there won't be a huge shift out of stocks and into bonds, which would cause rates to come down. And I don't think the Fed's going to make bond yields go down itself. So I think it'll be, but I think there's still a lot of demand globally for fixed income. People want, safe interest. And so, they're still going to grab at it whenever they can find it. And U.S. rates are still higher than, Europe and Japan, most other developed rates. So there'll be, demand for U.S. assets on an interest rate basis because the Fed will be ahead of the other countries' curve in terms of raising rates. So I think those will all kind of keep the balance of longer term rates where they are.
The balance. Well, Sam Burns of Mill Street Research, thank you so much for joining us. It's been a pleasure.
Oh, it's been my pleasure. Thanks so much for having me.